Okay, so chapter 17, this chapter is dealing with investment and business brokerage. So it's also going to deal with ownership of real estate by businesses. We're going to go over some concepts about investment terminology, why we invest, etc. So this chapter is going to deal more along the lines of investor terminology. Okay. And I believe we'll have a math problem here too. Well, I know we will. Okay. So chapter 17, investment and business brokerage. And we're going to go over some of the tax benefits and et cetera. We're not going to get into taxes in detail because we're not going to deal with the taxes so much. We're going to get into taxes slightly, but not in detail. All right, investing in real estate. Why do we invest? Well, first of all, why does somebody invest in anything? Why invest in anything? Any kind of an investment.
Make money.
Kind of
To make
security.
money. We call that to
Make
get a
money.
return on your investment, right? We want to generate some sort of a return on your investment. Well, you know what? There's a term here. So traditionally, real estate investors have shown overall rates of return higher than the prevailing interest rate charged by mortgage lenders. Return includes total income, both direct cash flow and indirect benefits, such as depreciation and appreciation. Often investors borrow money to finance real estate to purchase with the expectation that if held long enough, the asset will yield a greater return than the costs to finance it. Well, we know a 5% interest rate on a $300,000 mortgage for 30 years, you're going to pay almost double on it. So you better earn enough there in order for that to be true. In the past, yes, real estate has, doubled, tripled, even quadrupled and more in value. But is that going to be happening these days with today's values and inflation? Maybe someday, but who knows? Back then in the 20s, did people think that that would be the case? So you can't say for sure. We don't have that crystal ball, right? So using borrowed money this way is called leverage. Okay. So real estate markets vary widely with real estate prices keeping pace with inflation in some areas, holding their own in other states, and dropping sharply elsewhere. So what does that basically tell you? Real estate's local. And a lot of mumbo jumbo, all they're saying is real estate is local. It's local to their markets. You could have some areas that the real estate is doing awful all around it. But yet some areas are still high in demand and people are still going to them. We experienced that even in the market drop-offs. We've seen, for example, Westfield had a lot of, just like the communities around it. However, Westfield still held its own. It still held a pretty good market because it's in demand. Okay. So, what are some of the disadvantages of investing in real estate as the investment vehicle? Well, it's not highly liquid. Basically, that means people can't sell it quickly without taking some kind of a loss. Like if you buy stocks or bonds, you buy stocks in the morning, you could end up selling them in the next hour at a profit, but with real estate, that's not an investment that's where you make the money on the quick return. It takes time. You're probably not even going to sell it the same month at a profit, not unless you made some major repairs to it to fix it and flip it, right? To force an increase of value. So you got to require consultation with some tax experts for your investments as well. And there's a high level of risk involved. A lot of people think that they get involved in real estate and they end up taking a bath because they didn't know what the hell they were doing. So what we're going to do is highlight under disadvantages of real estate as the investment, highlight the first two sentences that say, unlike stocks or bonds, real estate's not highly liquid over the short period of time. This means that an investor usually cannot take some sort of sell real estate without taking some sort of a loss. Okay, go down to the near the bottom of the page, it says the investments, okay? Why have real estate as the investment? Well, to get a return is why we invest in anything. But real estate can have some positives for us. If held long enough, the property will appreciate in value, and then you could sell it and show a profit off of your investment. You could hold that property for income and rent it out, and it generates income as well as appreciating in value. So the object of income property is to create spendable income. Okay, we call that cash flow. Cash flow is spendable income after expenses. So under cash flow at the bottom of the page, highlight that first line. The object of owning income property is to generate spendable income, usually called cash flow. You want that cash flowing. So what is pyramiding through refinancing? Well, you keep refinancing property. Look, can you buy property with generally small amount of cash? Sure. If you're able to get 100% financing, buying in rural areas or through the USDA, or you can, if you're a veteran, get 0% financing. I'm sorry, 100% financing, zero down, or you can get financing to purchase real estate with little money down through the programs such as the FHA, right? Or the NJHMFA, the New Jersey Mortgage Housing Finance Agency, right? You could get low cost financing. It requires low money to put down. And then you buy real estate. Let's say I buy a 4-unit building that I'm going to live in with an FHA loan or one of those other loans, right? And I keep investing all my money back into that property. I pay it down, I build a lot of equity in it. Then I refinance it and take out all the equity. So I refinance that into a conventional loan now, take out all my equity that I built into it. What is equity? Equity is the difference between the market value of a property and what you owe on it. So I take out all that equity now, I refinance into a conventional loan. I find another 4-family house to buy. So I buy another 4-family investment property that I'm going to live in. I'm going to move out of this one. Now I'm going to rent out my old apartment. I'm going to move into the new 4-family house. I could use another FHA loan then again to buy it. You could only have one FHA loan at a time. However, when I refied and did that cash out refi, I refied on my home. I refinanced it into a conventional loan. So I don't have an FHA loan anymore. So I could use the FHA program again. That requires only 3.5% to put down, right? And I drained all the equity out of the one property, put it back in there for another 3.5% to put down, buying another. And you could keep doing this over and over again. And if you keep draining out all of your equity and keep doing that, you could find yourself owning millions of dollars of property in a relatively speaking short period of time. However, all your assets are going to be highly mortgaged because you keep pulling out all of your equity to invest in new property. There's nothing wrong with that. It's just, if market takes a dip or something and you have to sell, you may have a little issue. Okay, just wanted to explain what pyramiding through refinancing is. Okay, so what are the tax benefits of having real estate as the investment? Well, we can have deductions. So one of the main reasons of real estate investments that were profitable and popular in the past was that federal law allows investors to use loss generated by investments to shelter income from other sources. The IRS regulations, however, are subject to change, and they do change. This is why we are not going to go over it in any detail because we're not tax people. We don't need to worry about that. Too much tax shelter, though, meaning too many tax deductions or write-offs, they could backfire on you and subject you to a alternative minimum tax that the IRS can then impose on you. All right, so let's get into it. Where it says exchanges, I want you to write the number 1031 1031 above it or in front of it. So it reads 1031 exchange. And then highlight it, 1031 exchange. 1031 is a section in the IRS tax code that allows an investor to defer paying their income taxes on an investment property. Any, not income taxes, yeah, it's income from the profit of the sale of their investment property. If they reinvest that money and purchase another similar like kind investment property. So sometimes they refer to these as 1031 exchanges because that's the section within the IRS tax code, or they refer to them as tax deferred exchanges or like kind exchanges, all right? But this may be on exam 1030 as a 1031 exchange, okay? Basically, you would not pay income taxes until you eventually sell that property and realize that gain. Let's go to the whiteboard. This is not the whiteboard.
Oh, yeah, yeah.
Where's the whiteboard? Here it is. All right, so what is 1031 exchange? So here's an example of a 1031 exchange, okay? If you bought a can you guys see the whiteboard?
Yes.
Okay. All right, my video disappeared for a second. Last time that happened, I lost connection with you guys, so it scared the hell out of me. All right, so, okay, let me make sure we're back in that whiteboard. Okay, so this is an example of a 1031 exchange. You buy an investment property, multi-unit building for $300,000. I don't know why I'm keep losing the video. All right, so $300,000, you guys buy this investment property. It's a multi-unit building, right? And it appreciates in value, and years later, you now sell it for $600,000. Okay, if you just sell that property for $600,000, how much profit are you pocketing?
1,000.
So the difference in here is 300,000. There's a 300,000. What we call that is a capital gain. This is taxable. This is taxable income, right? However, if I take this $600,000 and I reinvest it in another investment property, and I reinvest that total $600,000, I don't have to pay any taxes on that $300,000 gain right now. We're going to defer the payment on that until such date that I sell this property when I eventually cash out at some point in my life, years down the road. When I eventually cash out on that, and hopefully I'll be in a lower tax bracket by then. I don't know, we'll see. When I don't pay as much in taxes, then I'll cash out, take out my profit, and then I would have to pay the taxes on it, okay? But this is a way that you could sell an income producing property or an income property or investment property. That's a better word I was looking for. You could sell your investment property at a profit and not pay the taxes on the profit right now. Okay, you're deferring that for some future date when you actually cash out. Now let's just say, you guys still there?
Yes.
Yeah.
So we're
Okay.
taxed on the entire 600,000 or just the 300 in the future?
Well, you only pay taxes on the profit. The profit would be 300,000. Remember, you bought it for 300, so the other 300,000 is going to be the profit. All right. Let's say that I reinvest only $500,000. That the next investment property I buy is only $500,000. Wait a minute. I'm cashing out on 100 grand of that profit now, aren't I? I'm only reinvesting 200,000 of that profit. So this, when you are using an exchange and you're reinvesting the money, but not all of it, the difference in value is called boot. Boot, okay? And boot is loot, and all loot is taxable, right? So I have to pay taxes on that $100,000 right now when I cash it out. If I'm not reinvesting that money, I have to pay taxes on it. And no, you can't say, well, can I just say that I'm cashing out my own money and I'm not cashing out the profit? No. IRS says you take out any money, you're taking out the profit first. So we're going to tax that first. Okay. So what did we learn here? Boot is loot and all loot is taxable. Now let's also learn something else. So this is can you see how this could be advantageous to an investor doing a 1031 exchange? However, when we do this, guys, anytime you're dealing with the IRS and getting a benefit from them, you better have, when you communicate with the IRS, it has to be on a special form, right? They always want it on their forms. I couldn't tell you what these forms are because I always work with either a tax attorney or a CPA. When doing 1031 exchanges, I have my client work with a tax attorney or CPA to do the communication with the IRS, and they tell me what the time frames are, because the IRS has strict time frames from the time that they tell them that they want to sell this initial property to the time that they purchase a property, that they put an offer in. They give them strict deadlines for how much time you have to close on that property, how much time you have to identify the next property, how much time you have to close on that property and purchase the next one, and everything. And then paperwork has to be filed at every stage there with the IRS. Otherwise, that investor will lose that tax benefit. And then they would have to pay taxes on that full $300,000 if you miss one of those deadlines. So that's why it's important for you guys as the real estate professionals to be aware of what the timelines are. Okay. So you'll communicate with that tax professional or the tax attorney about the timelines. All right. And then you guys just need to make sure that that real estate transaction moves along swiftly. Otherwise, you could be costing your client a lot of money. All right. Now, let's get over something new. Okay, so we know boot is loot. That's a difference when you sell an investment property and the next property that you're purchasing, there's a difference in value. That difference in value is known as boot. And what's boot? Taxable profit. Right?
Yes.
Okay. So here's another word for you though. Let's say we bought this property for $300,000. We call this basis. That is investment lingo. So the initial cost for any investment in investor terminology and investor world, they refer to that as the basis. That's the base price, your initial cost for the investment. Now, let's say I bought this property and then I dumped $100,000 of improvements into it. How much am I in that property now for? $400,000, right?
Yeah.
This is called the adjusted basis. All right. So what does that mean? If I sold this property for $600,000, what's the total profit?
200.
It's now 200,000 and not 300 because I dumped another 100,000 into it. Right. So when you add the money that you put into it plus the initial to the initial cost, the basis, you're left with the adjusted basis. You subtract the adjusted basis from the sale, and that leaves you with your taxable income there. Right. Now, it still doesn't change this problem. If I sell this property for 600,000 and the next property I buy for 500, I'm still cashing out 100,000 and still getting $100,000 profit now that I need to pay taxes on, right? That still doesn't change that. So the terminology that you need to know, you probably won't get this one on exam adjusted basis, but you will get basis. However, it's not bad to know this one for real life, even though we're not doing the tax stuff. And this one will be on exam, boot. And you might even see cash flow. What is cash flow? Spendable income. Spendable income is cash flow. That's after taxes. Okay, so we have this slide here. So we got the 1031 exchange. We learned a capital gain is profit, taxable profit on an investment. We learned that the basis is the investor's initial cost for any investment. And the adjusted basis is the basis plus the cost of any money that you put into your investment, any additional money that you added to your investment, which then will be, you could subtract from your profit, and then what's left is taxable. They can't tax you on the money that you already had, right? They can only tax you on the profit, the gain, the taxable gain. All right. So here's just an example of what we just did on the board there a second ago. Depreciation is a math problem that we're going to get from this chapter. So depreciation is an accounting concept to deduct the cost of an improvement, not the land. You cannot depreciate the value of the land. You can only depreciate the value of the improvement on the real estate. Why is that? Because land does not depreciate, right? You guys can hear me still?
Yeah.
I know that somebody just was talking was sounding like they were digitized. And the video keeps disappearing from my screen. So I just want to know you guys are still there. So make a noise every now and then.
Still here.
Want to make sure I'm not just talking to myself here for a while. That'd be kind of useless, right? All right. So depreciation is accounting concept to deduct the cost of an improvement for an investment property for taxation purposes. So it's not actual loss of value on the property, though. This is an accounting concept. Okay. Before we get into it any deeper, let's do some highlights. Under 1031 exchange, you guys highlighted the first sentence under 1031 exchange as well?
Yes.
If not, do it now and write 1031 in front of it. It's a 1031 exchange. Then turn the page. And on page 298 at the top of the page, I want you to highlight when the property being bought, the replacement property costs less than the one that's being sold. The difference in price is known as boot. And what is boot? Boot is loot, and all loot is taxable. That's mine, by the way. If you want to steal that saying, you can. Boot is loot, and all loot is taxable. You could steal it for the purpose of remembering it, okay? Now, capital gain is taxable profit on a sale, right? So let's highlight capital gain is taxable profit on an investment. Then the next section, basis, we're going to highlight in the second sentence, basis of a property is the investor's initial cost for the real estate, or just the investor's initial cost. Then on page 299, highlight the title depreciation. Then highlight depreciation is an accounting concept. And put a highlighted box around the entire paragraph. Okay, so what is it? Okay, so depreciation, once again, is an accounting concept that allows that investor to deduct the cost of the improvement on their asset of their investment. It's not an actual loss of the value of the property. It's used to reduce taxable income that investor may have before taxes are computed. So for instance, if you make $100,000 that year and you can write off $10,000, I'm sorry, you can depreciate $10,000, you subtract $10,000 from your $100,000 income, that leaves you $90,000 income for the year, and then you calculate your income tax off of the $90,000. Okay, it's not taking $10,000 off of money that you owe. It's reducing your taxable income before the taxes are computed. Okay, so a property's value cannot be deducted all at once. Okay, just like any large investment that a business would have. If you buy a fleet of trucks, if you buy a truck for you to add to your fleet for your business, you cannot deduct the full cost of that asset. If an asset is large enough, I'm not exactly sure how the IRS goes about this, I'm not a tax guy, but if an asset is large enough, these assets, certain assets need to be depreciated over a period of years. I think vehicles have to be depreciated over a period of 7 years. Real estate has varying periods. On a residential property, the cost of the building can be divided. It can be depreciated over a period of 27.5 years. And commercial property, the cost of the building can be divided or depreciated over 39 years, the anticipated useful life of those assets. So let's do a math problem on it now. And here I got a problem on the board. If a property is valued at $500,000 and the land is estimated at $150,000, the land value is estimated to be at $150,000. If the property has an economic lifespan, that's the terminology that they use. So actually above this math, above in your book, above the section of depreciation, I want you to write economic lifespan like this. Actually write economic lifespan of an improvement. Okay, everybody do that for me, because that's the terminology that they use on exam. Anytime you see a question that mentions the economic lifespan of an improvement, they're talking about this depreciation problem. So if the property has an economic lifespan of 27.5 years, how much would it depreciate after 3 years? This is a very similar question to what you get on state exam. And I think I have one on schools. No, I don't yet, but I will be adding one like this to school. All right. Basically, the way you do this problem is like this. You got to subtract the land value because land cannot be depreciated. So subtract the value of the land from the total property value, and you're left with the improvements value. And then that improvement can be depreciated over 27.5 years. So you divide it by the economic lifespan of 27.5 years, and that gives you an annual amount that you could depreciate from your income every year of $12,727.27. Now the question didn't ask on an annual basis, it said after 3 years, how much would you have depreciated, right? How much could it be depreciated? Well, just times that by 3 now, and that gives you $38,181.82. Because you got to remember this, land does not depreciate. So you got to subtract its value from the total. That is a problem that you probably will get on state exam. Okay. That wasn't a hard one though, was it? It's pretty straightforward. Right?
Yeah.
Yes.
Yes.
Okay. See, you don't got to be scared about math. And here's another slide, just putting it in a different format. Instead of having a screen print from my whiteboard, I made another slide to put it up there, explaining it again. All right. All right, deductions on federal tax. All right, so federal tax law limits the deductibility of losses from rental property. First $25,000 of a loss can be used to offset the income of any sort. Okay, we don't need to get into this, okay? You're not gonna get this on exams, so let's not get into this. Tax credits, understanding what a tax credit is. Let's highlight that under tax credit, the first sentence. A tax credit is a direct reduction in taxes due rather than a deduction from income tax before it is computed. Like the last depreciation problem, we figured out that each year you can deduct, you could reduce your taxable income by $12,727 and change, right? So if you made $100,000 a year, let's just say that this was $10,000 that you could deduct. So then your taxable income would be $90,000 a year, right? You're just subtracting that from your income, lowering your taxable income. However, with a tax credit, if you have a tax credit of $10,000 and you owed $10,000, now you owe nothing, all right? So a tax credit is better. It's a direct reduction in taxes due rather than calculation of taxes before from income before taxes are computed. So this is often given to people who have been who are renovating historic properties or non-historic buildings placed in service before 1936, or landmarks, landmark properties, okay? Now, sometimes the government also gives its incentives of tax credits. I added in here this bullet point that when we had that real estate market crash, politicians think they always have the answer to it. They're so arrogant, aren't they? So they offered us, they said, you know what? We could stop this property crash, which if you actually talk to anybody, any investment specialist or anybody that monitors the markets, they referred to this as a market correction, okay? Because prices have been artificially inflated over the years. Because we changed the way that people were able to borrow money. And because we made it easier to borrow, that means people that already were able to afford to borrow can borrow more now. And when that happens, if people can borrow more, how much is a seller going to want for their property when they got a bunch of people that are out there now willing to buy? Supply and demand, baby. Prices go up, right? So sometimes, in this case, the government offered a tax credit. They did two of these stimuluses. The first one, they offered a $7,500 tax credit for anybody who rushed out there and bought property, hoping that enough people will rush out there and buy properties that that could prevent the market from crashing. Okay, so this is an actuality. Let me draw a picture for you what actually happened here. Let me just clear the canvas. So just to draw you a little picture. Let's say real estate markets are cyclical, right? They go up and down over the periods of years. So let's just say that the real estate market was on a climb like this. And then they did some stuff for financing that allowed people to get a lot more money than normal. So the property values started going like this. They started climbing steeply. That's due to an artificial cause. It's only a matter of time that it's going to hit its peak, and then that's going to start to crash. It's going to deflate, and it's going to start coming down, and it's going to start coming down hard, right? So politicians said, no, we could stop this. So over here, they offered a $7,500 tax credit to anybody who will go out there and buy buy real estate to try to stop the bleeding in hopes that they could. Here, we're used to talking about the coronavirus now. In order for them to flatten the curve, you know, anytime these politicians talk about flattening the curve, they have no idea what the hell they're doing, right? We're going to just experiment and see if it works, is basically what they're saying, to try to flatten that curve out and prevent. And if enough people go out there, rush out and buy real estate, the property values won't keep dropping, right? Because there'll be a demand that they're creating in the market. But these idiots aren't business people. They don't know what the hell they're doing. So they offered that, and it worked a little bit. It did this. All right. So basically, the market is still correcting itself. It's just going to take longer to correct itself now because they flattened the curve out a bit, but it's still going down, right? So people who rushed out to buy real estate to take advantage of this $7,500 tax credit had to take a little bit of a gamble. Are we near the bottom yet? It's got to be near the bottom. And if it's not, maybe that $7,500 tax credit will make up the difference, that it'll still be worth it for us to go out and buy. However, there was a little catch to getting this $7,500 tax credit. You had to live in the house for 3 years. If you sold it before 3 years, you had to pay it all back to the IRS. And then after the end of that year, what happened? Property values started dropping steeply again. So what did these people start doing? Just like these people were doing at the time? Short sales to avoid foreclosure. You know, these people were trying to cut their loss. They seen that the property values are continuing to fall like a brick. So they were trying to salvage their financial situation. So then they do short sales. Oh, wait a minute. If we were able to negotiate a short sale with the bank, did all that hard work, and had the bank agree to sell their property and call it even Stevens, well, these people were still a little screwed, weren't they? Because they didn't live in the house for 3 years. The IRS comes knocking on your door at the end of the 3 years. You owe us $7,500. So do those politicians fix a problem for people, or they just bring more people into the problem and screw up people's finances?
Screw them out even more.
Now, what happened was, at this point, politicians stepped up again when they were getting called out for that BS. And they said, no, you know what happened? Let me tell you what happened. We didn't throw enough money at the problem. So you know what we're going to do? We're going to offer now an $11,000 tax credit. Pulling numbers out of thin air. I don't know where that came from, 11 grand. Guess what happened? It almost leveled out the market. Almost. It's still falling. What happened at the end of the year, do you suppose? When that tax credit went away, the market continued to correct itself. So all they managed to do was delay the inevitable. They made the problem, instead of that problem being done years earlier, they managed to string it out another 2 years. All right. And pull all these people who took advantage of these tax credits. Now these people that sold that property when the value started dropping again, now IRS comes knocking on their door. You now owe us $11,000. And you must pay. There is no shorting the IRS. They want their money. Okay? So politicians have the answer to the problem in the end?
Not at all.
This is what really happened. And if you guys, any of you guys watched that Big Short yet that talked about this? Actually, they never talked about the tax credit part, but they talked about the market. It led up to the market crash at the beginning, that movie. All right. Anyway, that's what this tax credit's talking about. So installment sales contracts are also known as what? Land contracts, right? Remember, a land contract is an installment sales contract. It's the type of seller financing where the buyer makes payments and they wait for the deed, right? So the buyer does have a financial interest in that property. However, that financial interest is called equitable title. All right, the owner doesn't own the property though, or the buyer doesn't own the property till they pay off that full amount owed, okay? Now, there's some tax rules and such. Once again, they should consult with their tax specialist about this. So next to installment sales at the bottom of the page, 299, just write land contract. Page 190, chapter 11. And turn the page. So they just talk about how the taxpayer who sells real property receives payments on the installment sale, which the purchase price is paid over a period of years, and they may report it as profits because they're earning interest. They're acting as the lender instead of the buyer going to a bank. They're getting the financing to the seller, and the seller may be charging them interest on there, probably. And so therefore they're earning profit on that. And how that works, well, consult with a tax professional because the complex tax rules involved. And it deals with the investor's tax rate and everything, okay? So we don't got to get that deep into that. Now, on the bottom of page 300, we're almost done, taking a little bit longer than I anticipated, but we're almost done. Maybe about 10 more minutes on here. So the business organization, so a real estate investment trust or syndicate, I'm sorry. What is a syndicate? It's not a formally created business entity. It's a syndicate is the joining together of two or more people to carry out a business project. When that project is done, the syndicate's done, right? So the joint venture is similar to a syndicate. However, it's two or more groups to carry out a project. When the project's done, the joint venture is done. Now, to try to keep you guys out of jail, let me explain to you something, all right? Here's a little warning. When seeking money from investors, because you guys are going to be in the real estate business helping investors find properties, and after a while, you guys are going to get this eagle eye that you could spot a good investment property a mile away. You're going to see the possibilities on this property that looks like garbage of what you could do to it, because you're going to see other investors buying properties, tearing them down or fixing them up, and you know they have the ideas. You're going to start observing, and you're going to be learning all these ideas, and you're going to be like, wow, that's a great investment. I'm going to buy it if I had the money. So how can I get the money? Light bulb goes off in your head. I'm going to advertise to try to get investors to invest in my project for the property that I will own. Wait a minute. If you're owning the property, how are you going to get an investor to want to invest in your property? Answer.
Percentage of the property?
Offer them a percentage of the profits on that property, right? Wait a minute. Now you got to be careful, because if you advertise to get investors to invest in a project that you own, and especially if they're not savvy in real estate as an investment, this could be classified as a security. And when dealing in securities, you need to have special licensing, the Series 6 license, right? The federal government, the SEC, the Securities and Exchange Commission, you need to be licensed with, as the property needs to be registered. And New Jersey has something called blue sky laws that regulate this stuff as well. And if you're dealing in securities without a license and proper registration of the federal government and state, you're going to jail. So to avoid that, partner up with somebody who does have, if you want to do this, you could do it still if you partner up with people that have the proper licensing and do it the proper way. Or not partner up, but hire somebody who has the proper licensing to help you do things the right way, to make these public offerings. Otherwise, you could have a problem. Now, if you took these investors to partner with you and you're all co-owners, that's a different story. Okay. You have to inform them of what the possible risks are involved, especially if they're not a savvy with real estate as the investment vehicle. Now, we remember business partnerships. We got general partners and limited partnerships, right? A limited partner is limited in their liability, that they could only lose their initial investment in the business, right?
Mhm.
All right. REITs are real estate investment trusts, and real estate investors who invest in REITs can get the same tax benefits as mutual fund investors. You guys already have that highlighted in your book
Yes.
Yes.
on page 301. Okay.
Yes.
If you don't, under real estate investment trust, you're going to highlight real estate investment trust, REITs. Real estate investors can take advantage of the same tax benefits as mutual fund investors. Now, in order for a REIT, in order to be classified, an investment to be classified as a REIT, it must have at least 100 investors, and at least 75% of that trust income has to come from real estate as the investment vehicle. You don't need to know all that for exam. For exam, what you need to know, real estate investment trusts can take the same tax advantages as who?
Mutual fund.
Mutual fund investors. All right. At the bottom of page 300, I want you to highlight on the last sentence. I want you to, under forms of syndicates, I want you to highlight the limited partners stand to lose only as much as their interest, nothing more. General, and then on the next line, highlight general partners are totally personally responsible for excess losses incurred by an investment. And then you could give a little cross-reference for business partnerships on page 111. We went over that on page 111. Do you need to have a real estate license to sell a business? You do not. So you do not, as you can see on this slide in front of you, you do not need to have a real estate license to sell a business unless real estate's included in the sale. And then you do. First of all, when you're selling commercial property, can we sell commercial property?
Yeah.
Yes, we can. We just cannot prepare the contracts of sale for them, right? Only an attorney can. Okay, well, when we sell a business, what do? We don't prepare the contracts for that. An attorney does. All we do is market the business, find the buyer. Then we hand it over to the attorney. All right, so when selling a business, we're not just dealing with the real estate or leases that may or may not be involved, but also the selling of a business includes things like possible things like fixtures or the stock or inventory of the business name, its trade name, which could be a LLC, corporation, what have you. You're selling the customer lists and the goodwill. Other things that could be included are special rights like copyrights or patents or franchises. Would you know the first thing about transferring them?
No.
This is why we need an attorney to handle that. Or any other special licensing like lottery machines, like ticket lottery machines. Can they be transferred from one party to the next? Attorneys would handle all that. Okay, well, when you're buying a business, substantial money is required in order to buy it, okay? Anyway, so turn the page. Oh, wait. Under business opportunity sales, last sentence, first paragraph. I want you to highlight a person who sells or negotiates the sale of a business for others for a fee is required to be licensed as a real estate broker. The exception is when the business is sold without any real estate. So basically, do you need to have a real estate license to sell a business is what it's asking in a backward worded way. And the answer is no, unless real estate's involved. I like the way I say it on the slide. It's simpler, it's more direct and straightforward, right? Would you agree?
Correct.
Or do you like the book's wording?
Just less
You don't got to pander to me. Just let me know. I'll change my wording if you like backward talk. You know. Anyway, so UCC. This is the last thing in this chapter. This is a different UCC. This is not the Uniform Construction Code that we learned about, which is the state's minimum standard of construction that's maintained by the Department of Community Affairs in Trenton, right? This is the UCC. This is the the DCA, Department of Community Affairs. This is the UCC, the Uniform Commercial Code, that regulates the sale of, regulates business transactions and business sales. The part of the UCC, the Uniform Commercial Code, this one has a different meaning, not Uniform Construction, but Uniform Commercial Code, is the Bulk Transfer Act, deals with the sale of real estate. All right, so what do you need to know for exams? So the Bulk Transfer Act is part of the Uniform Commercial Code that would prevent fraud in business sales. It protects the business seller's creditors from selling the business and then leaving the creditors unpaid, which is fraud. So the Bulk Transfer Act, Article 6 of the UCC, that's what it is, regulates the transfer of chattel. What is chattel?
Personal property.
Tangible personal property when selling a business. It prevents fraud when a business is sold. It requires business sellers to make a list of all outstanding debts to their creditors and to supply that list to potential buyers. And then it also requires them to notify the creditors that the business is indeed for sale. This would prevent the seller, the business owner, from selling the business and saying, hey, listen, all the inventory or all the machinery is included in the sale. So all the equipment and all the inventories for sale is included in the sale when it's not paid for yet. Sometimes creditors will give the business owner machinery or inventory on credit, and they bill them and then they got to pay them later, right? This is a common practice. So this would prevent a business owner from selling the business, saying everything's included when they haven't paid for everything themselves yet. And then they leave town with the profit, leaving those creditors unpaid. It's fraud. And if you, as the real estate agent, help them sell that business and help them perpetrate that fraud, you were helpful in helping them commit a crime, a felony.
Oh.
So get an attorney involved when selling a business, let them handle this. But basically it is, you need to let the business owner know that when selling the property or when selling the business, they need to make a list of all outstanding debts to creditors. If they say all the inventory is included, ask them, has it been paid for yet? You know, you think it's like a simple, stupid question, but you know what? If you don't ask it, you ain't going to get the answer to it, right? Because you may get an answer that will shock you, because often it's not paid for yet, and it needs to be. So in New Jersey, the Bulk Transfer Act protects who?
sellers, correct.
The business seller's creditors. Now, it also protects the buyers, but that's not the main purpose of this law. It's to protect the seller's creditors. As a side effect, it protects the buyers. This is like homeowners insurance. When homeowners insurance is required, when you get a mortgage loan to buy a house, the lender requires you to get homeowners insurance, rather, not mortgage insurance, homeowners insurance. Who does homeowners insurance cover?
The homeowner.
No. It's insuring the collateral for the property. It's insuring the property. And the property is the lender's collateral.
Mm.
The lender needs to be named as the payee. They're the one that's going to receive any payout from the insurance company. Right?
Yep.
Remember, words that end in EE is the person that's receiving. Okay. Now, the homeowner, they could get a side rider that would cover their personal belongings in that property. But the reason why the lender requires it is because they're insuring the lender's collateral. So it protects the seller's creditors. You will get this on both exams. What law pertains to the sale of business chattel or business personal property? The Bulk Transfer Act. And who does it protect? The seller's creditors. You need to know that for exam. And the rest of this just talks about what I already spoke to you about. And that's that. And that's the end of this chapter. Let's do the key terms to review. And then we're done for the day. All right. So chapter 17, key terms to review. Oh, wait. Let's highlight. Let's do some highlighting first. In the second paragraph under the UCC on page 302, highlights on the second line, second paragraph, the Bulk Transfer Act is designed to protect the creditors from fraud perpetrated by business owners who sell the business, including the equipment and stock, and disappears, leaving creditors unpaid. That's a short explanation that's direct to the point. Then go all the way down to the last paragraph. All the way down to the last paragraph and highlight on the first line of it. Bulk Transfer Act is designed to protect the interest of, stop. Even though it says the buyer there, I don't want you highlighting that. I want you to go to the next line, couple words in, highlight the seller's creditors in the sale of a business. And then the next line directly below the word business, highlight covered under the Bulk Transfer Act, just business personal property, chattel. Actually, it's not a bad idea to write that at the end of there. Chattel. C-H-A-T-T-E-L, or you could even throw an S on there. Chattel or chattels. Chattel or chattels. And I know we're over 4:30, but let's just finish this up. Let's do the key terms to review. Costs plus improvements minus depreciation.
Adjusted base.
Adjusted basis is correct. One is A. A document transferring ownership of personal property.
Bill of
Bill of
sale.
sale.
Bill of sale, 4 is B, correct. How do we transfer the owner of real estate, ownership of real estate?
Deed.
Deed,
Deed.
correct.
Deed.
All right. Extra money received by one party in an exchange.
Loot is loot. Loot is
That's right. See, it works. 5 is C. Boot. Increase in value.
Appreciation.
Appreciation, 2 is D. Initial cost of real estate.
Basis.
3 is E. That's the basis. A law regulating the sale and financing of business personal property.
Bulk
Bulk
transfer.
Transfer Act.
Transfer Act.
6 is F, correct. Bulk Transfer Act. Money left from rental income after the expenses are paid.
Cash flow.
Cash flow.
Cash flow, you want that cash flowing, right? 8 is G. Profit on the sale of an asset.
Capital gain.
It's a
Capital
capital
gain.
gain, correct. 7 is H. Real estate held for rental income.
Income property.
Income property.
11 is I, income property. Some of these are kind of obvious. A tax deferred mutual transfer of income property.
Exchange.
Exchange, 10 is J, or 1031 exchange to be more exact. Yearly bookkeeping charge for part of an initial, this is horrible definition. 9 is K. 9 is K.
Depreciation.
It's a horrible definition. Anyway, key terms to review 2. Cash flow plus income tax savings plus appreciation. These are all examples of what?
Return.
Yes, 7 is A. They're all a form of return. Direct deduction from income taxes due.
Tax credit.
Tax credit.
9 is
Credit.
B, tax credit. Extensive use of borrowed money for purchases.
2.
Pyramid.
Leverage, 2 is C.
Leverage.
Fund making real estate investment and selling shares, although I can understand how you could select pyramiding.
6.
Real estate investment.
Yes, 6 is D, real estate investment trust. Group pooling resources to buy real estate.
5.
Syndicate.
Syndicate, real estate investment syndicate, 5 is E. A joining together of 2 or more people to carry out a business project.
Syndicate.
That's simply a syndicate, 8 is F. Law regulating the transfer of business, personal property.
10.
Uniform.
10 is G, the Uniform Commercial Code, that UCC. Rate at which the investor's top dollar is taxed.
Marginal tax.
Marginal
3.
tax rate.
3 is H, the marginal tax rate. Refinancing property to buy more.
Pyramid.
That's pyramiding. 4 is I. And a sale in which the seller receives purchase price over a period of years.
Installment sale.
Installment sale.
Installment sale, 1 is J, and we're done with chapter 17. All right. All right.
What was E and F again?
E and F on what? Number 2?
Privacy.
Which section?
Number 2.
Okay. E was 5 is E, and 8 is F.
Thank you.
You're welcome.